SEBI, the markets regulator, is warning investors to be cautious against certain SMEs, some of which, SEBI is pointing out, paint an unrealistic picture of their operations. Now, SEBI is asking investors not to invest based on any tips and rumors, especially the kind that come on social media, and those are being red flagged. Let's find out exactly what SEBI is saying from my colleague Anurag Joshi. He's joining us here in the Mumbai newsroom. Anurag, now SEBI is raising this red flag about certain SME IPOs that have hit the markets thick and fast in the recent past. What exactly is it saying, and what would SEBI like investors to do about any kind of rumor and this kind of information that we get on social media about these SME IPOs?
The Securities and Exchange Board of India has warned investors to be watchful and careful about certain practices that are related to SME companies. SEBI has asked investors to be cautious while investing in such securities. SEBI's observations follow its findings that post-listing, some SME firms and specifically their promoters are resorting to projecting an unrealistic picture of their operations and also showing a very rosier side of the business to attract investors, and they are making announcements which could potentially be misleading for investors. So SEBI has asked investors to be very careful about such kind of announcements, and these kind of statements from such SME companies and the promoters could typically relate to corporate actions such as bonuses and stock splits and preferential allotments.
Thanks for walking us through what SEBI is putting out on SME IPOs. Let's get further perspective on this from JN Gupta. He is the Managing Director at Stakeholders Empowerment Service. Great to have you with us, Mr. Gupta. Firstly, just help us understand the massive subscriptions that we see in SME IPOs these days. The primary markets are flush with such issues, and retail buyers seem to be lapping them up. Why do you think that's happening in the first place?
See, we got to understand what is happening in the market all around. See, the markets are booming. You have seen Sensex 80,000 plus, Nifty 25,000 plus, and all that. So what is happening is this, that people have a feeling of missing out in the rally. So what happens, whatever I get here and there, let me get hold of it. So, and if you see the pattern of trading, most of the IPOs post-listing are giving initial gains. No one knows whether those gains will continue for a year, 2 years, or 3 years, or something. But what happens is this expectation builds up momentum and vice versa. And this is where the problem lies. If you look at this, I was reading in today's paper, Times of India, where it is written that a company which has only 8 employees has garnered 400 times subscription.
Yes.
Now, that is the issue which is obviously worrying SEBI.
Yes, indeed.
But unfortunately,
we find it quite strange, Mr. Gupta, that it took a 12 crore IPO of a two-wheeler dealer who has all of 2 Yamaha showrooms, just 2 showrooms, and that IPO got oversubscribed as much as 400 times. The promoter was looking for 12 crores. He attracted 4,800 crores. And yet it's not the first time. A 5 crore IPO has got 2,000 times oversubscribed. And on an average, I'm looking at data, Mr. Gupta, SME IPOs, they get oversubscribed 200 times. And that's normal according to the data I've been looking at. So the question is, now that SEBI is raising a red flag over this, I'm just wondering if it is too little too late.
No, again, I will say the demand for equity is increasing. What people are seeing, that if they buy from the secondary market, the gains are not 100%, 200% overnight. Whereas few people are getting gains 100%, 200% in IPO. So what people are seeing, rather than buying in secondary market and see your shares going up 5%, 10% or whatever it may be. So people are putting it as a lottery system that let me apply, I don't lose anything. The moment I get allotment, I make 100% or 200% money. That is what is happening. But unfortunately, the situation is that whatever SEBI may do, whatever you may do, whatever I may do, we will never be able to remove greed from the mind of investors.
But that's how markets typically function, Mr. Gupta. Markets do function on greed and fear. But what is different this time about SMEs, that's the key point. Now, Sebi is saying that some of these SMEs at least paint a rosy picture of their operations. They announce bonus and preferential issues. They announce stock splits. Is there a clear way in which these particular SMEs function? And if so, what's the end game for them, in your understanding?
Again, I am saying, sitting here, we cannot brand all SMEs bad. Out of 100 SME IPO,
Yes.
5 or 10 may be really exceptionally good.
Right.
But that will be only the post-facto analysis. When you analyze and do before issue, everybody, and there will be people who will say, this is going to gain 200%, 500%, and people are trying to garner oversubscription. So all these factors, the basic factor which always be there, I may not get the same amount of money by investing in secondary market because I will not be able to buy 100 shares of Infosys or 100 shares of G Telecom or 100 shares of Page Industry. So let me put some money, and if I get lottery, I will double my money. This is where the people are driven. But
then how do you separate the wheat from the chaff, Mr. Gupta? Sebi is making a pointed remark about the misuse of social media to put out investment tips, push rumors. But the question is, how do you even control social media? How do you get investors to sift what is true and what is false?
See, again, that is where I'm saying, whatever you may do, whatever I may do, whatever Sebi may do, whatever MCA may do, whatever NSE, BSE may do, as long as I am swayed by what my neighbor says or what some unknown people on social media says, oh, this share is golden opportunity, it will triple or 4 times. If I am ready to fall in trap, none of us can control it. We can only educate. It is always something like that. You can bring horse to the pond, but you cannot make him drink water.
Perhaps some norms, the NSE recently tightened those norms for SME IPO and listing criteria. They've introduced this positive free cash flow to equity for at least 2 out of the 3 financial years. They've mandated that before they apply for an IPO, they must have this FCFE. Is it a good enough metric to ensure that a company has a proven track record to generate value for shareholders?
Again, I will say Sebi already tightened something.
Yes.
And must be working on something. The issue is very simple, that SME IPOs are not vetted by Sebi. SME IPOs are vetted by respective exchanges if it is being listed on BSE or NSE. Now, the SME IPO cannot have the same scrutiny as for main board IPO because then none of the SME will be able to come. That is where the compromise was done, that in order for a small company to come to the listing, they should be given a lenient regulation and their scrutiny should not be as detailed as for main board IPO. And that is where the problem is happening. But eventually, as I say, that if there are mishaps in the market,
yes,
probably the regulation will be tightened enough so that entry is not completely blocked.
Right.
Entry is made a little bit difficult.
Right, right. Mr. Gupta, it's a pleasure getting your perspective on this. Thanks very much for joining us on this important subject on this edition of India Tonight. Really good having you with us.
If you like this video, then like, share and subscribe to ET Now.